been consistently hitting record levels. 25,000 is there on the charts for everyone to see. We are now inching closer to 26,000 as well. But of course, there are some big events lined up. First one being tomorrow's Fed rate decision. What are your thoughts? Because some publications have, left a 50 basis point on the table as well. So this will be the first rate cut since 2020. We all know that. But would you place your bets on a 25 basis point, or would you be in that camp where there are very few who actually expect a 50 basis point rate cut?
Good morning, Nandita, and good morning, all the viewers. Thank you for having me on the show. Obviously, the D-Day is around the corner, and I haven't seen. Normally, Fed is known for giving the predictive outcomes, what they are going to do in the coming times, but there is divergence, right? Almost, I would say, if we can split it around 50-50%, close to that, that someone expect that there would be a big cut of almost 50 bips, and then large section of the society, of the investors segments expect there will be 25 bips cut in the tomorrow's meet. What I understand around and what I expect them to do almost somewhere close to 25 bips, because you see, there are certain data points which has not really shown that US is going to see a hard landing. And if they go and hit a 50 bips cut in their first meet, probably it will send signals that US economy is actually in a very tough situation, and there is a high probability of hitting a hard landing, which will possibly gives a lot of uncertainty and volatility to the market. So I believe Fed will actually play smart and give a 25 bips cut to start with, to see wait and watch mode, and then see how things will pan out. But if I look at this three, we have these three meetings in this calendar year. And if we look at the Fed fund rate, there is a probability of almost more than 115 bips of cut. So market is really, really excited globally. And we will have to really watch and see what they will do. But I believe 25 is more or less given. I think that should be the way out to bring to lessen down the volatility in the market. Second most important thing is, if you look at the metal commodities, right? If you look at gold, if you look at other, even base and ferrous, non-ferrous both, the expectation of rate cut of 50 bips is given. If you look at this, the way metal commodities prices are moving, and the money moving to the emerging markets, Nandita, if you see in the month of August, both equity and debt almost have seen an inflow of $32 billion, out of which $1.8 billion was in equity and the remaining was in debt, which is a big sign that the money rotation is happening on expectation of sharp cut. So all the data are saying things differently. Rate cut is given, 25 bips more or less given, 50 bips is what the excitement is all about.
Right, 50 basis point is what the excitement is all about. But do you see a major knee jerk if it doesn't come by? Do you think 50 basis point is pretty much priced in? Because we saw the Dow also clocking a record close yesterday, right? So in case a 50 basis point doesn't come by, as you also said that the Fed could actually give out a 25 basis point, which is what a section of the market is also envisaging. But they are getting excited because there are chances of a 50 basis point as well. But if that doesn't come by, do you think the rally that we've seen even back home could be at risk, and there could be some bit of correction kicking in?
Yeah, so if I really look at more than 25 bips or 50 bips, what is more important is what the dot plot looks like. What is the projections of the rate cut looks like for Fed. I think that will indicate where the market will go. And historically, we have seen, and which is we have learned over the years, that whenever the event has happened, probability of it being discounted is much, much higher. So once we see when we hit the wall and we see the Fed has started cutting rate, large part of that excitement is more or less gone. So I think this two factor will play out how the market will behave. But what is more important is that dot plot, the future expectation of cut. If Fed gives an indication of even 75 to 100 bips of this calendar year in three meeting, I believe market might see some volatility here and there, but it will, eventually remain in a safe zone, if I may use the word. Because what we have to understand here is that definitely there are signs of US economy slowing. Whether you look at the employment data, whether you look today they will become out, coming out with the retail data. So it will obviously help them in the recovery. and the burgeoning amount of debt is so big, that possibly there is a bigger catastrophic event which can play out. So it will definitely bring relief, but obviously small here and there, profit booking on account of the event has already happened, or if the outlook doesn't look very promising on rate cut, then possibly what we are
Mm.
expecting, and either that can play out because markets are all-time high level both in US and obviously in India also here. So profit booking can't be ruled out completely.
Okay, profit booking can't be ruled out. But want to talk about the big, stock or the big event that took place yesterday. That was Bajaj Housing listing, and we saw the stock is already a multi-bagger upon listing. Yesterday, of course, it was, it hit the upper limit, and today as well, it's up 9%. But my question is, uh, because of this bumper blockbuster listing, do you think the entire sector is in for a re-rating? And also, another part to this question is all those investors who didn't really, get allotment of the IPO. Do you think, it is wise to look at it now post listing, given the fact that it is already a multi-bagger?
So, Nandita, we are in interesting times. 100% listing gains has become a norm. Happening with such a large cap, I think it's the excitement market is running on them. I believe, obviously, they have done a phenomenal business. We are very, very positive on housing and BFCs space. That's why in our fund, we have gone overweight in this category. That's the primary allocation for us in our banking and FSI space. And we believe this is one area where the government focus as well as the valuations both are there. Government is focusing on housing and at all strata, and valuations, at least compared to what other sectors and segments are, looks promising. Uh, for long term, specifically from Bajaj Housing, obviously they are the leader in the space, and we have seen the wealth creation happen with Bajaj Finance. Technology is in favor, growth is in favor. So obviously, if you have a very long term outlook, buying at these prices will definitely create some wealth. But what I want to bring to for investors is there are many other housing finance companies which are possibly growing at higher rate compared to Bajaj Finance, and possibly we will see those re-rating happening into those NBFCs where the market cap is around 10, 15, 20,000 crore, hitting 30 to 40,000 crore in a couple of years. That is where the excitement is. On valuation front, many of these mid-sized housing finance companies are trading at 50-60% cheaper with relatively comparable or similar kind of financials. Obviously, the size makes all the different, but where the growth it will be more sacrosanct, and when the valuation reading, there is more on the table for the investors. So I believe there are plenty of opportunity in the housing finance space where when investors can put their hard-earned money to compound. If someone who want to relatively take a lesser risk, Bajaj Housing Finance is obviously an option, but there are other on the plethora which they can add and create alpha over there. But if we are very, very positive on this space, to be honest.
Okay, but what about banks now, private banks? The private banking pack has just about started to reverse its underperformance. But sector-wise, there is an intense fight for deposits, and once the rate cycle turns back home as well, uh, a lot of experts are saying that perhaps December would be the first rate cut for us as well. But if that happens, then margins which have not really been, which have been under pressure, could come under further pressure. So, in light of all these considerations, should one look at private banks, given their valuation comfort?
So Nandita, I think private banks and some particular NBFCs are the one which is providing value propositions where the valuations are still in sync with their earning growth, and they are, have that comfort on valuation parameters. But the excitement for investors for private banks has been missing. Even if you look at the FIs, they are not really excited about their allocations, incremental allocations to private banks, given the outlook for growth is muted, right? They at best will do mid-teens kind of a growth, where there are opportunities in other sectors and spaces where the growths are much higher. So in that case, when the excitement is not there, we have learned it hard way that that is where the money should be parked. So we believe, good allocation of investors' money now should go and being put into these high quality private banks where we see a strong earning growth of 15-20%, where we have the valuation comfort on during times of down drawdown. And given we will see that the kind of credit growth happening and at the best of the quality of NPA been reported, we believe at least 1.5 to 2 years of asset quality stability and decent credit growth will support the valuation rating for these private banks. Coming on the rate cut, we believe that the rate cut would not be very deep in India. When we saw the rate hike, I think India didn't participate much in the hike. So even on the way down, we don't expect too much happening on the rate cut. In this calendar year, maximum what can we see? There would be 25 bips cut from RBI. We saw almost 3.6 kind of inflation number, industrial activity numbers are pretty decent. So India is in a sweet spot. So I don't think RBI will try and move things around aggressively. And even if we see 25 to 50 bips of rate cut in the next 6 months, I think it will beneficially be more to NBFCs rather than private banks. So that is where a healthy allocation to high quality private banks, preferably housing finance companies or preferably your vehicle finance where they have higher exposure to CVs or even two wheelers. That kind of a portfolio could do well in the next 6 months, given when we see a rate cut situation happening here. I think for in India, the rate cut situation will be more beneficial for debt-lending companies rather than on the banking as per se. So it will be more of a narrative than on substance on actual numbers in that space. Obviously, PSU can benefit on yield movement, but that large part has also been factored into the stock prices. So I believe private banks should be I would say, a place to hide the wealth that has been created over the last 2 3 years, and that could be remunerative for the next 2 3 years of a kind of a return we will see.
Okay. So last question really, Aishwarya, which is that one pocket that you feel could emerge as a dark horse going forward? Because we know that defensives have been doing well now, and focus has shifted from PSUs, given the fact that a lot of those defense names, railway names have come off quite a bit from their highs. So which is that one pocket do you think that will take the lead here on?
So when we look at the market and we look at the whole spectrum of sectors, what is exciting me now is chemicals and possibly leg one or leg two minus intermediary companies which are supporting to pharma. So we believe that the obviously the if you look at the last 3 years, it has been pretty difficult for chemical companies given the pricing pressure, given the destocking in China, and obviously the slow growth globally. But most of these things are now gradually recovering, where we are seeing that pricing are stabilizing. Valuation from 60, 70, 80, 100 time PE has gone to 25, 30 time PE forward. Majority of these companies have done reasonable capex in the last 2 3 years. They have strengthened their R&D. So and we are seeing that the commentary and the deal pipeline of majority of these companies is pretty strong. And in the last 2 3 years, we have not seen any dilution in the return ratios. So we believe that could be one area where we should see that money allocation should happen. Obviously, we have seen this act passed in US recently, where the China plus one game will get further boost to the whole thesis. So chemical is a space where we believe the value creation can be more remunerative for the investors. Similarly, if you look at the intermediate players, the CDMOs and CRMs, players like that, is where we believe the money rotation will add to the investors' kitty. So those are the areas. Similarly, like we were positive on IT 6 7 months back, or pharma on 6 7 months back. That thing will possibly play out in chemical in the coming 2 to 3 years. In short term, possibly next 3 to 6 months, a scenario can remain more or less flattish, not much to happen around that number. But if you have a 2 year view, we believe definitely believe chemical can add alpha.
Okay, chemical space looking interesting now. With that, Aishwarya, I'm afraid we are timed out on this show. But thanks a lot for taking our time and joining in. We had an interaction after a long time, but I wish to have a longer one with you sometime soon when you come back.